Okay, let's begin. Um, Hello and welcome to this 60th lesson in financial accounting. So, what we're looking at today is quite interesting and it's very important. These are elements of the financial statements. So, these they form part of the financial statements when you're sorting out the financial statements. That's where you cover the recoverable dates, the accruals and prepayments, and other factors. Okay, so in this lesson, as I've already stated, we're looking at irrecoverable debts and provisions, right? Irrecoverable debts and provisions. So now, let's begin. What are irrecoverable debts? Let's begin with irrecoverable debts. So there's sometimes in the business where you sell on credit, right? Let me just get my pen here. So you sell on credit, you sell goods maybe worth 500, on credit, and this is what we call a receivable, right? We've got this receivable here. We have that receivable. We have that receivable here. So now, the issue here is sometimes due to one reason or the other, maybe our data has gone bankrupt. They've gone bankrupt, they don't have any money, they've been taken to court, they've been liquidated, they don't have any money to pay us back. So what do? We need to write these 500 off. We need to write it off as an irrecoverable debt. It will never be paid back. That's what irrecoverable means. We write it off, we have assurance, we have certainty that it won't be paid back. That's what we call a irrecoverable debt. Right? So recoverable debts are debts. Okay, a recoverable debts, a debt which is not expected to be paid back. This is exactly what I've explained. Somebody owes you and they don't pay back. So what do? You need to write off that debt. You write it off, saying, okay, this debt won't be paid back. So how do you write off? When you're writing off, the irrecoverable debt is part of the expenses of the company, right? It's part of the expenses of the company. So you say we've got this 500, you say, okay, it's going to be written off. We need to include it as part of the expenses because it has gone out of the business. It will never be paid back. So the double entry is one, you debit the irrecoverable debt as an expense in the statement of profit or loss. So the debit goes in the statement of profit or loss with the description of irrecoverable debt as an expense in the statement of profit or loss. And then the credit goes in the control account. We are going to look at the control account, I think, in the next lesson. Then the credit is in the control account, right? So I'll repeat, the debit is in the statement of profit or loss as an expense. Then the credit is in the control account, right? So now, when this debt is paid back, right, the debt is recovered. The debt is recovered, so you debit. Since we've received money, you debit the cash or bank, depending on how that payment was received, and then you credit the irrecoverable debt as an expense in the statement of profit or loss. So one thing that you need to understand is in the statement of profit or loss, a plus, is a credit, right? Then minus is a debit. So the statement of profit or loss is like that of the bank. It's the opposite it's opposite to the general order of things, the debits and the credits. So this is just something that you need to have at the top of your head. But this is not really the most important aspect of the exam. So what's most important in the exam is this example. Do you have an example here? I think we have an example. Okay, so the example is at the end. So let me first look at the allowance for receivables. I think the example is at the end. So let me just go back a bit. Irrecoverable debts, these are debts that will never be paid back and they are expensed, right? So irrecoverable debts, the debts which will never be paid back and they're expensed. All right, so they're expensed in the statement of profit or loss, and then the receivable in the statement of financial position. We have to make sure we deduct this amount which has been written off. Provided we've been told in the exam no, it was not written off, then we need to deduct it from the amount of the receivable. So maybe we've got receivables of 1,000 here, and then 500 are bad, that are recoverable. So this receivable, so this 500 we recognize it in the statement of profit or loss as an expense, and then this same 500 we deduct it from the 1,000. So now in the statement of financial position, the value of the receivable is going to be 500. Then allowance for receivable. So an allowance, it's also it has the idea of a bad debt, but in this it's like we're just trying to make an allowance, saying okay, looking at the conditions of our customer, maybe this debt has been outstanding for so long, so maybe our credit period is 6 months, then the debt has been outstanding for, say, did I say 3? So the debt period, the credit period that we agree with the customer is 3 months, and then it's been 6 months and there are no signs of this customer paying back. So what do? We need to make an allowance, saying okay, perhaps this loan will not be, or rather this this receivable will not be paid back. So an allowance for receivable is an estimate of the percentage of debts which are not expected to be paid back. So I just thinking, or just assuming, saying okay, perhaps given the conditions that this debt has taken, maybe they might not pay back, the debt might not be paid back. So it's made when a company expects recoverable debts but does not know which ones. So there are two provisions. So there's general provision, right? There's general provision, okay, and there's also specific provision, right? There's also specific provision. So let me just erase this. There's also specific provision. So let me use this to explain. So maybe let's say we've got 3 creditors. Let me just say 2 for simplicity's sake. We've got Banda here. We've got Banda with 1,000. Then we've got Piri. We've got Piri with 500. Right? Just for simplicity's sake. So the total receivables that we have are 1,500. We got 500 from Piri and 1,000 from Banda. So now when we make a general provision, we say, let's say we make a general provision of 10% of receivables are going to go bad. We just make a provision, right? So now general provision means the total amount of the receivables, which is Banda's debt plus Piri's debt, which is 1,500. So 10% of 1,500, right, which is 150, right, 150 kwacha. That's the general provision. That's the general provision. But if we saying, oh look, let's make a Banda is not doing well, his business is not doing well, or let me just say Piri's business is not doing well, the debt has been outstanding for 6 months, but the debt period is 3 months. We followed up and it seems like he won't be able to pay back. And when we say okay, let's just make a provision of 500 for Banda, maybe Banda might not pay back, and that's what we call a specific provision. So a specific provision relates to a specific receivable, a specific debtor. Then general provision is a percentage of all the receivables that we have that we project perhaps they might not be paid back. Right, so this is something that you need to just wrap your head around. So allowances are made when the company expects irrecoverable debts but does not know which ones. Then it serves as a prudence. So this is just something that you had to have off the top of your head. So now let's look at the double entry. So what's a double entry? So an example: DTCO expected irrecoverable debts of 5,000, 2,000, 2,500 in the financial year 2022 and 2023 respectively. But how come? Okay, I think it's supposed to be an extra year here because these are three. Yeah, supposed to be in 2024 because here I see 2024 here and 2024. Anyway, so respectively, prepare the double entry. So what we usually do, so we say in 2022, right? We debit the expense. Where is this expense? This is a statement of profit or loss. You debit the statement of profit or loss. Remember, a debit in the statement of profit or loss is a minus. Then a credit in the statement of profit or loss is a plus. So in the first year, we debit the expense of 5,000. Then we credit the irrecoverable debts account, right? And then 2023, we do the same. We expense because we had irrecoverable debts of 2,000. We expense 2,000 and then we credit 2,000. So for irrecoverable debts, the double entry is the same. It's very easy. Expense, debit, you credit the irrecoverable debt account. In 2024, the same thing, you repeat: expense, debit, you credit the irrecoverable debt account. And this is the amount. So the recoverable debt was 2,500. You debit the expense with 2,500. You credit the recoverable debt account with what? 2,500. So now, let me just try to demonstrate using my Excel how you're supposed to write it in the exam. So in the exam, we focus more on the irrecoverable debt account. Irrecoverable debt account. So we open the irrecoverable debt account like this. This is what you're asked in the exam: irrecoverable debt account, right? So now, what you do here, you say we begin with the year. So let me just put year here, year. Then you've got a debit here. Then you've got a credit here, right? So so this is what you do. Recoverable debts, it's just the same. This is where you say you recoverable debt. It's the creditor. So in the 5,000, the first year is 5,000. So you just say profit or loss, profit or loss, profit or loss, 5,000. Then you're done with the first year. So year just move this here. Okay, year 2022. Then you're done, right? So now in 2023, the irrecoverable debts, they increased, right? Or let me just do this for demonstration's sake. So you close it, you say total 5,000 there, and then you say balance brought forward of what? 5,000. And then you say balance carried forward of 5,000, right? But in the exam, you don't really need to do this. In the exam, what you need to do is this. Actually. So this is the normal way of doing things in the normal working environment. But in the exam, what you need to do is, so we've got 2022 here, then you put 2023. 2023, the dates increase, right? The recoverable dates in the following year were 2000. So since the recoverable dates, you credit it, so you go to the recoverable dates again, you say profit or loss. I think that's 2000. It ends there. Yeah, and then in the 2024, you repeat the same process. You just say 2024. You put it on the credit side, profit or loss of 2,500. When you do this, then you've obtained the marks, and you've obtained the marks just like that. So the recoverable dates, they're a bit easy. This is all you need to do. But what is a bit of a complication is the provision. So this is a provision account. So let's begin. So let me just copy the debits and the credits. So this is the exam treatment. So in the exam, this is how you need to sort it out. This is how you need to do it. This is how you need to carry out the double entry for the recoverable dates. Right? When you're given a series of years, you've got 2022, 2023, 2024. This is what you need to do. But maybe if you're only given 1 year and you've been taught to carry out a double entry, which is highly unlikely, you need to, just say profit or loss here, and then you close it. Right? But balance brought forward, balance carried forward, and then you open the new year. You say it's 2024 here. Right? 2024. Right? And then you also include this, 2000, balance brought forward, balance carried forward, just like that. But in the exam, for simplicity's sake, this is what you need to do. So now let's look at the provision account. Right? Provision account. Okay. Okay. So I think there's a mistake in how this PowerPoint is organized. But anyway, so let's look at the provision account. So the provision account, DTCO made a provision for doubtful debts. So this is what they say, provision for doubtful debts of 5,000, 20,000, 2,500 in the financial year 2021-2022, as well as 2023. So this is the correct question. Respectively, prepare the double entries for the years. You see? So now, what you need to keep in mind is provisions are not real expenses. They are just a notional expense. We're thinking maybe this customer that we have might not pay us our date. So what do? We need to be prudent. We need to make sure we recognize that perhaps this person might not pay, then we just have that proportion. So it's not always that you're given a specific amount. Sometimes you just be given a proportion, a percentage of the receivables, and then you need to find the actual amount that relates to that particular debt. So now, how do we carry out the double entry? So in the first year, 2021, we need to debit a statement of profit or loss. Remember, debit is a minus in the statement of profit or loss, and the credit is a plus. So this is how things are arranged in the statement of profit or loss. So now you debit the statement of profit or loss with 5,000, and then you credit a provision for doubtful debts with that a 5,000, right? Then in 2022, so what you need to analyze in the following year, what you need to analyze actually is the increase in the provision. So increase or decrease in the provision. So let me just read through this. So these are important notes. So at the initial stage, a provision made is included as part of the expenses. This is what we've done here, right? And then in the subsequent period or subsequent stage, the following year, an increase in the provision, right? In the statement of profit or loss, it's included as an expense. And then it's deducted from the value of the receivable. That's in the statement of financial position. Then a decrease is included in the expense as a negative value. It's included as a negative value, right? It is a notional income included as part of the expenses, and then it is deducted from the value of the receivable. So now an increase in the provision increases the amount of expenses. So it's debited in the statement of profit or loss. Remember, a debit in the statement of profit is a minus. The statement of profit or loss is a minus. Then a credit is a plus, right? So now when there's an increase in the provision for doubtful debts, you need to include that amount as part of an expense, as part of the expenses, right? But if there's a decrease, if the amount of receivables decrease, so I want to explain this before we go through the question. If we got 5,000 here, and then in the following year, the expenses increase. Let me begin with increase. They increase to 5,500. 5,500. So this increase here is what you include as an expense, right? As an expense in the statement of profit or loss, and then you add this amount to the receivables because there's an increase. So you rather the amount of the provision, you add this to the amount of the provision, right? You add it to the amount of the provision. Are you getting me? So in the statement of profit or loss, you add this to the expense. Then the same amount in the provision account, you add it to the already existing provision, right? But if there's a decrease, let's say our provision was initial provision maybe in 2022 was 5,000. Then in the following year, the provision decreases to 4,000, right? It decreases to 4,000. Then here there's a decrease of what? 1,000. So initially we had 5,000 provision, it decreases to 4,000. Then there's a decrease of what? 1,000. This 1,000 in the statement of profit or loss, it's included as part of the expenses. But in the expenses, this decrease, you need to put it in brackets to signify that it's an income that's included as part of the expenses. So it reduces the amount of the expenses, right? And then this same amount, you need to deduct it from the already existing provision, so that at the end of the period we have this 4,000, because the provision that we've recorded is the already existing provision is 5,000, so we need to decrease this for 5,000 so that it comes to 4,000. So how do you do that? You need to deduct that 1,000 so that we arrive at the 4,000, and this is what we're going to do here. So in the initial stage, we had 5,000. So 5,000, we just include it as part of the provisions account, right? You credit 5,000, right? You say profit or loss, profit or loss, profit or loss. So you need to know that the debit is where is in the statement of profit or loss, right? So how much? I think it's 5,000. So at the initial stage, we've got what? 5,000. This is 2020 what? 2022. Now in the following year, what happens? 2022, what happened? 2023, what happens? Is there a decrease or an increase? So I'll reiterate, I'll repeat. When you are looking at the provisions, you need to just look at either an increase or a decrease. So in the following here, what happened here, there's a decrease, right? So from 5,000 to 2,000, right? There's a decrease. So I think this is supposed to be 2,000, not 1,000. This is supposed to be 2,000. I think I was very fast when I was preparing this. So there's a decrease of what? 2,000. So from 5,000, the debt decreases, the provisions decrease to 2,000. And what did I say? When there's a decrease, it means that amount is credited in the statement of profit or loss, right? The increase, the increase is included as part of the profit or loss, right? So for this, let me try to do this. So let me close the account first, 5,000, and then here you've got the balance brought forward, and then here you've got the balance carried forward. The balance carried forward is the same, so that you can be able to understand it properly. 5,000. And then in 2023, what happens? There's a decrease. So if there's a decrease, right? This is the opening balance. Then there's a decrease, right? There's a decrease. What do we do? Here we say, let me just put it here. Let me move this here. Here you say profit or loss. You debit the provisions account. Why? Because the credit is in the statement of profit or loss, right? With what? The decrease, which is 2,000. We are getting it. We're debiting here, but the corresponding entry is in the statement of profit or loss. The credit is in the statement of profit or loss. And what do we say? In the statement of profit or loss, the credit is considered as an income. An income is a credit. A debit is a decrease. So now here, let's close the account. So we've got total there. Total. Sorry, I don't know if I saw it properly. So there's a decrease of 3,000 actually, not 2,000. So it's from 5,000 to 2,000. So there's a decrease of 3,000. 3,000, not 2,000. My mistake there. Of 3,000, right? So this 3,000, let's close the account. We close the account, we bring the total here, the total of 5,000, and then we have the balance brought forward of what? 2,000 here, right? Why? Because the total here, we copy this. We copy this and we paste it here. Let me just write it. Total. Right? You've got 5,000 here. And then this 5,000, minus this 3,000 is going to give us this 2,000. So the idea is, okay, at the end of the period, what do we want to have? At the end of the period, what we want to have is this 2,000 that we have here. That's the amount that we need to have. That's the amount that we need to begin the new period with. You get it, huh? And yeah, that's why we have this. So now we bring it forward. So balance brought, we carried forward. Sorry, balance carried forward of what? 2,000. There, balance carried forward of 2,000. Then, right? Then we begin the new period. Right? This is the amount that we begin with the new period with. This is the amount that we begin the new period with. Right? And then in the third year, it rose to 5,000. The provision rose to 5,000. Then what do we do when there's an increase? All right, that increase in 2024, that increase is supposed to be included as that. There's an increase, so we deduct it from the statement of a profit or loss. And we said when we're deducting, a minus in the statement of profit or loss is a debit. So the debit entry is in the statement of profit or loss, and then the credit entry is where? In the provisions account. But now that extra, the excess of 500 is what we bring here. We just say profit or loss 500, right? And then meaning our total here is going to be what? 2,500. We bring the same total here, same total of 2,500, right? Since there's nothing here, we bring forward the same amount. The balance brought forward of what? 2,500. Then you bring it here, the balance carried forward of 2,500. It means this amount is the opening balance for the provision account. This is what we this is the current amount that we have for the provisions. Right. Yes. And this is the double entry for the provisions account. So let me just follow this same format even for the for the doubtful debts, for the recoverable debts. It's just easy. What do you do here? You just find the total here. There's not much that you need to do. Just find the total, which is 5,000. Right? You come here, the same total, you bring it here, 5,000, and then you say balance brought forward of what? 5,000. Then that same amount you bring it here as the balance carried forward 5,000. This is the amount that you begin the new year with. Oh no, sorry, no, what have I done? No, so actually it closes, not you begin the new account with, but actually this account, it closes, right? You don't really begin with a new period with this amount. No. So what usually happens, since this has been written off, it's closed. Yeah, you don't begin the new year with this amount. Sorry for that. And then in the new year, you repeat the same process. Right? You say credit statement of profit or loss here, right? That, then yeah, there, yeah. So, but I think this is just going to confuse you, because in your mind you're going to be like, okay, balance brought forward is going to be brought here as well, but let me not include that, so to avoid the confusion. But what you need to know is this account is closed. Why? Because we don't have any other follow-up transaction, because you include in the statement of profit or loss, and then you close the account. Right? In the following year, the same is carried out. You find the total here, you close the account. You find the total, you find the total, you find the total, you find the total, and then you close the account. You find the total and close the account. You don't take anything forward, you don't carry anything forward, you just close the account. You just close the account. You just close the account. So I just did this for understanding sake. But one thing that you need to have off the top of your head is this account needs to be closed. So you just find the total here, 2,500, and the total there, 2,500, and then you close the account. So yeah, so this is how the recoverable debts are. What you need to remember is recoverable debts, you don't carry anything forward, you don't bring anything forward. All you have to do is close the account. When you make the entry profit or loss on the credit side, this account needs to be closed. This account needs to be closed. But for the provisions, this is where you carry forward the closing balance. But what you need to know is, in the subsequent years, what you need to look for is an increase or a decrease. An increase is treated as an expense, the debit is in the profit or loss, the credit is in the provisions account. And then for a decrease, it's a notional income which is included as part of the expenses. It reduces the amount of the expenses, and then you need to enter the debit in the provisions account. So with that said, our lesson here has come to an end. Thank you very much.